90% of professional Wall Street traders lose to a dead simple two-fund portfolio over a 20-year period. Think about that for a second. Guys with PhDs in mathematics, supercomputers, and million-dollar algorithms get completely destroyed by an investing strategy that takes exactly 15 minutes a year to manage. If you have ever lost money trying to pick individual stocks, or if you feel completely exhausted trying to keep up with daily financial news, crypto updates, and endless charts, I want you to take a deep breath. The financial industry desperately wants you to think that investing is a highly complicated game. They want you to believe that you need to be actively buying and selling all the time. Why? Because every single time you trade, they make money on commissions and hidden fees. Complexity is exactly what makes them rich, but it is exactly what drains your wealth over time. Today, I am going to show you the ultimate set-and-forget lazy portfolio. It consists of only 2 index funds that you will ever need in your lifetime. You buy them, you ignore them, and you let them build your wealth until you retire. Before we dive into the exact funds, I need to quickly mention that everything in this video is for educational purposes only. I am sharing my personal research and strategies, not providing formal financial advice. All investments carry risk, so always do your own research before putting your money into the market. All right, let's get into it. Think about your own experience with money so far. You probably tried finding that one stock that was going to go to the moon, right? And you probably ended up holding the bag when it crashed. You tried following crypto signals on Twitter or Reddit. It is completely exhausting and emotionally draining. You tried watching daily market news. It is stressful, confusing, and honestly, entirely useless for your long-term wealth. Studies consistently show that the average retail investor actually underperforms the S&P 500 by nearly 4% every single year. And let me be clear, it is not because you aren't smart. It is because you are doing way too much. You are overcomplicating a process that is supposed to be boring. Think about investing like fishing. You could run around a massive lake holding 10 different fishing poles, constantly changing your bait, and stressing out over every tiny ripple in the water. Or you could just cast one giant, perfectly designed net, sit back on the beach, read a book, and catch everything in the lake automatically. In the world of finance, better returns do not come from higher complexity. Complexity is just a tax on your wealth. So, let's build your net. Here are the only 2 funds you will ever need to buy. Fund number 1 is a total stock market index fund. The classic example is VTI if you want the entire US market, or VT if you want to own the entire global market. This fund is your primary growth engine. By buying this single fund, you instantly become a partial owner of thousands of the most powerful and profitable companies on Earth. Apple, Amazon, Microsoft, and all the tech giants, when they grow and make profits, your money grows. But here is the secret advantage of a total market index fund that most people do not understand. It has an automatic self-cleansing mechanism. If a company is poorly managed and its stock price starts dropping, its weight in the index automatically shrinks. If the company goes bankrupt, it simply falls out of the fund entirely. On the flip side, when a massive new company emerges and starts taking over the world, it is automatically added to your fund and grows in size. You do not have to research which company is going to win the AI race or the electric vehicle race. You just buy the fund and the winners are automatically pushed to the top of your portfolio. Yes, the overall market will go up and down in the short term, but over a 20 or 30-year horizon, human innovation pushes the market in one direction, up. Now, fund number 2 is a total bond market index fund. Think BND for the US market or BNDW for global bonds. If the first fund is your growth engine, the second fund is your shock absorber. When the stock market crashes, and let me promise you it will crash multiple times during your investing lifetime, bonds usually hold their ground. Sometimes they even go up in value when stocks are panicking. Bonds pay you a steady stream of cash interest, and they keep your total portfolio from completely collapsing. This is incredibly important for your psychology. The biggest mistake investors make is panic selling at the bottom of a crash. When you log into your account and see your stocks down 40%, it is terrifying. But if you have a solid chunk of your money in stable bonds, it softens the blow. It stops you from making emotional decisions that could ruin a decade of hard work. And that is it. Just 2 funds. A lot of people ask, why only 2? Shouldn't I be more diversified? The truth is, any more than 2 funds, and you are just pretending to be a sophisticated Wall Street trader. More funds just mean more headaches and spreadsheet math when it is time to manage your money. You might be thinking, what about real estate? Real estate investment trusts are already inside your total market fund. What about small cap companies? They are already in there. What about the next big artificial intelligence boom? The biggest AI companies are literally the top holdings in your fund right now. You already own the entire haystack, so stop wasting your time trying to find the needle. Now that we have the two funds, the most important question is how much of your money goes into stocks and how much goes into bonds. Because if you get this ratio wrong, you might take on way too much risk or way too little. Here is the 5-minute cheat sheet for lazy investors. The simplest mathematical rule of thumb is to make your bond percentage equal to your age. So, if you are 30 years old, you hold 30% in bonds and 70% in stocks. If you feel like you have a high tolerance for risk and you want to be a bit more aggressive, take your age and subtract 10. So, a 30-year-old would subtract 10 and hold exactly 20% in bonds, leaving 80% in stocks. If you do not want to do any math at all, here are the 3 buckets. If you are under 40 years old, go heavy on growth with 90% stocks and 10% bonds. If you are between 40 and 55, move to 75% stocks and 25% bonds. If you are over 55 and approaching retirement, protect your wealth with 60% stocks and 40% bonds. Listen to me closely on this point. There is no perfectly optimal number. The perfect number is simply the one that lets you sleep peacefully at night when the news is screaming that the economy is ending. As you get older, say every 5 years, you just take 5 minutes to shift 5% from your stocks over to your bonds. That is your entire lifelong risk management strategy. So how do we actually execute this? I am going to give you a 4-step action plan. You can set this up in 15 minutes this afternoon. Step 1. Open a brokerage account. Vanguard, Fidelity, Charles Schwab, or if you are outside the US, Interactive Brokers is fantastic. Do not overthink this step and get stuck in analysis paralysis. Just pick a major broker that offers low fees and commission-free ETF trades. Step 2. Buy the funds based on your chosen percentage. Let's say you have $10,000 to invest and you decided on an 80-20th split. You simply buy $8,000 of VTI and $2,000 of BND. When you buy, use a market order, not a limit order. Limit orders are for day traders fighting for pennies. You are a long-term investor building generational wealth. Just buy it at the current market price. Step 3. Turn on DRIP. That stands for Dividend Reinvestment Plan. This is a simple, automatic setting you can toggle inside your brokerage account. It means that whenever your funds pay you cash dividends, the broker immediately takes that cash and buys more shares of the fund for you. You don't do a thing. It is the ultimate compound interest hack. It is like having a silent business partner who takes all the profits and continuously reinvests them to grow your empire. Step 4. Leave it alone. Seriously, this is the hardest part for most people. Do not check your account every week. Delete the stock ticker widgets off your phone screen. Stop reading financial doom-scrolling news. Once a year, and only once a year, log into your account for 5 minutes to rebalance. Rebalancing is simple. Let's say stocks had a massive year, and your 80-20th portfolio naturally drifted. So now it is 90% stocks and 10% bonds. All you do is sell that extra 10% of stocks and use the cash to buy bonds until you are back at your target 80-20th ratio. Do you know what this forces you to do? It mathematically forces you to sell high and buy low without using any emotion whatsoever. I know what the skeptics are thinking right now. Does this actually work when the world falls apart? Let's look at the cold, hard data. In the massive 2008 financial crisis, the S&P 500 dropped by roughly 50%. It was a complete bloodbath. People were losing their homes and their life savings, but this boring two-fund portfolio, it only dropped around 35%. Your shock-absorbing bonds did their job. Because the drop wasn't as severe, you wouldn't have panicked, and your money would have fully recovered and been making new all-time highs within just 3 to 4 years. You don't just have to take my word for it. Do you know what Warren Buffett, the greatest investor of all time, put in his will for his wife's inheritance? He gave very specific instructions. 90% is to go into a standard S&P 500 index fund, and 10% into government bonds. If a brutally simple strategy like this is good enough for a multi-billionaire's family, I am absolutely certain it is good enough for us. The financial industry is going to keep trying to sell you complexity because that is how they pay for their sports cars. You do not have to play their game anymore. Your only job right now is to close this video, open your brokerage app, buy these 2 funds, and then go live your actual life. Go travel, go spend time with your family, go focus on your career. Stop trying to beat the market and just own the market instead. I'm Tony, and thank you for watching Grow with Tony. I hope this strategy brings you a lot of peace of mind. If you want more no-nonsense, lazy investing strategies that actually work, make sure to hit that subscribe button right now. And before you go, click on my channel icon to check out my other videos on how to build wealth without the stress. See you in the next one.